Alright folks, welcome back to a regular video, finally, after a couple months of everything just being in a certain series like the Revivals in Vogue, the ICT Mastery Mentorship, stuff like that. Finally, a regular by itself type video, okay? In this video, we're going over liquidity engineering. Most of the time I will say in this episode or in this revival, but instead it's in this video because it's by itself. We're going over liquidity engineering. Now, what in the world is that? If you've ever watched ICT, because I know there's some people that watch my videos that just watch anything other than ICT, like T-Trades, TJR, they will watch anybody else but ICT. But if you have, you'll probably hear ICT say something like price engineered, has engineered buy side liquidity here, and then sunk lower into this fair value gap. You say something like that. You'll hear the word engineering sometime some place in this video. You will hear it, and you've probably heard it. What liquidity engineering is it's basically when price does three things. Not exactly does three things like at once, but it'll do one of these three things in order to do something else, okay? So it has a sub-objective for its main objective, okay? That main objective would be to accumulate liquidity. Then the sub-objective will be to accumulate liquidity, and for example, the main objective will be to push price back higher to seek buy side. Something like that. It's basically pre-manipulation. This concept will make you foresee manipulation and what price is trying to do. It's a pretty overpowered concept once you learn it and you understand the types of liquidity and how it accumulates it and how it seeks and how it does it. It's pretty overpowered because there's multiple forms of liquidity, there's multiple forms of manipulation, there's multiple forms of the way price would do certain things. There's multiple forms of almost anything when it comes to ICT concepts. So once you learn liquidity engineering, it's kind of overpowered, okay? So we're going to go over a couple examples of how price seeks liquidity, okay? And liquidity, we're going to go over a couple examples of it. Liquidity can be old highs or old lows, okay? Fair value gaps, nope. Just kidding. Not fair value gaps. Why? Because remember, for example, a bullish fair value gap. If we have a bullish fair value gap, there's within the range of that fair value gap, the area of it, the actual fair value gap itself, in that area, there's only buy orders. So there's no sell side liquidity there. There's only buy orders. That's why it's called a bullish fair value gap, because there's a gap within the fair value or the gap between buy side and sell side delivery. There's a gap between there. There's strictly buy side delivery and no sell side delivery whatsoever. No selling was offered. That's why when some people say internal range liquidity, as in fair value gaps, that's not a thing. Okay, the only forms of liquidity you got is old highs and lows, a liquidity void, and I'm sure there's way more that I probably haven't mentioned yet. But you have accumulated liquidity, like when price accumulates liquidity, just a bunch of forms of liquidity. Okay, just to mention some before we get started. But let's go ahead and begin. We're going to start with this day here and just look and see how price just plays with liquidity. We're just going to see how it plays with liquidity. So let's look around this 9:30 opening on this red line right here, this red vertical line. We can see right before 9:30, this is a form of liquidity engineering, you can see how it's accumulating. What is it accumulating? Sell side liquidity, okay? So I'm put my little optical or whatever down here, and we're going to mark this as accumulated liquidity. It purposely accumulated liquidity, okay? Pay attention. It purposely accumulated liquidity in order to send the market into a temporary discount, manipulating other ICT traders that do not know this concept, and retail traders also, because there's also some retail traders and ICT traders that do get manipulated by this because they don't know. If you don't know, you don't know. You just simply don't know. That's why I'm teaching you this, because this is a very, very important concept. But just 15 to 20 minutes before the 9:30 opening, it accumulates liquidity, all right? It's like the algorithm has a mind of its own. Pay attention to this. Let's zoom in real quick. Price accumulates liquidity for about 23 minutes, okay? 9:30 kicks in. We purge just a tad bit of that accumulated liquidity. Not all of it, because we still want to manipulate. We purge a tad bit just to send price higher temporarily, okay? because if we want to come back down into this liquidity, we have to go higher first, then come back down. Or we could have just, went lower. But price was like, nah, let's not do that. We're gonna manipulate. We're gonna truly manipulate first, because that's normally what price would do at the first 10 minutes or first 20 minutes of the 9:30 opening, in which it does here, just back and forth movement. After that minor liquidity purge, it sends price higher. Buyers are like, okay, it's going up, it's going up, it's going up. Nope. And it sells off, and then you get manipulated. This is where the real move comes in, right around here. This right here, also, this is liquidity engineering. This move here, I wish I can circle that wherever the drawing tool is. This move here, right there, and this move here was all liquidity engineering. This is all liquidity engineering. I'm gonna explain the reason behind each move. I already explained this one on how it temporarily went into a small part of the accumulated liquidity down here to head higher into a temporary premium. Now, after that, price begins to reverse. Right around here, we reverse lower, and we go into the rest of that accumulated liquidity down here. That is liquidity engineering. Okay? We purposely accumulated liquidity before the market opened. The market opened. Is it sought? I think the word is sought. It's either sought or it's seeked, whatever the word is. But I think it sought a very small amount of liquidity to send price higher, manipulating buyers or any form of people that want to buy, or the dumb money that's on the buy side, they get manipulated. Okay, during that manipulation, price is also manipulating another form. It's coming lower to seek all the accumulated liquidity once again to go higher. So all this right here was liquidity engineering. This was all rigged. This is why I say, sometimes I say this, but this is why I sometimes say that the algorithm has a mind of its own. Because if you pay attention to the way it does things, and you just see it and you wait, it's like, oh wow, this market's rigged. Because it is. It's really rigged. It truly is rigged, and no one can convince me that it's not. Because I'm showing you things right here that is just there's no way to prove it wrong. There's no way to prove the theory that the market is not rigged wrong. You can't prove it wrong. And then after that liquidity purge, or that liquidity engineering around here, what does price do? Finally goes higher. There was a little bit more liquidity engineering around here if we really want to get into that. But what I'm going to do for now is I'm just going to go to a whole new day, which is, if I can find it, all the way Friday. Yeah, around here. So here we are. And remember, like I said, I'm going to type this out real quick so you can screenshot it. Liquidity. Let me use this real quick. Liquidity is it GI? I think it's engine. I might actually be stupid. Yeah, I think I might actually be stupid. Liquidity engineering, okay? It does this in 3 different ways. Accumulating liquidity. 2, let's see, purging liquidity. And I think that's really it. Yeah, there's really only 2 ways. Accumulating and purging liquidity. That's simply it. That's the only 2 ways it could engineer liquidity, okay? But whenever it is doing these things, pay attention to the 2 on when it happens and in what condition are we in, like what condition the market is in. Like, you get what I'm saying? Really pay attention to what's going on, what's happening on the higher time frames, what's happening even just like a couple candles before it, a couple 5-minute candles before it. Just really pay attention to what's going on, because that's what's going to give you like your, oh wow, that's what price wants to do. That's what's going to make you realize like, oh, that's what's going to give you that oh. So make sure to pay attention whenever price is accumulating and it's purging, aka manipulating. Okay, so pay attention. We're gonna pay attention right now. That's what we're about to do. So here at the 9:30 opening, we have some lows here. Well, a lot of lows. I don't have to mark them, but you see all these lows previously. Okay, you do see this. After, during the 9:30 opening, during and after it, immediately what we did was we purged this high here. After purging this, price was sent lower into a temporary discount, going into this low here and reaching into this fair value gap here. Okay, that is our temporary discount right along there. Fair value gap. You might be like, if fair value gaps aren't liquidity, why did it seek it? Or why was it sought? I think, is that the word? Hold on, let me take a little break real quick. Sought definition. Okay, I was right. It's sought. Okay, I thought it was stupid, but no, that is the correct definition. I'm glad I searched that up, so now I can use that word confidently. But the reason price sought this fair value gap was because it has to offer the other side of the market. Because remember, there's only buy side delivery being offered. There's only buy orders being offered. So price will have the tendency to head back lower to, offer the other side of the market. So it can be balanced, okay? Because there is an imbalance right here. That's why it's called an imbalance. That's literally it's a no-brainer, okay? After that, that that sought lower, or that seeking lower, whatever you want to say. I don't really know how to use the word, but you get what I'm saying. Price begins to head right back higher, okay? If you see this up here, pay attention to this. Pay attention. We're going to go ahead and mark this as accumulated liquidity so you can already get the idea of what price wants to do. But accumulated liquidity up here, we're going to do it just like that. After seeking these 2 points, this fair value gap and this sell-side liquidity point right here, we immediately head back higher in reverse. We come into this rejection block right here. And we respect it a couple times. Wherever my rejection block thing is here, right here. Comes to the rejection block a couple times and then just heads back lower. So we're still in that temporary discount. Then, right here, we seek liquidity again, or purge liquidity once again. After that, we reverse and have a break in market structure. This is indicating that price wants to reverse. We also have this breaker right here. I think it ran through the breaker. Yes, it did. It did indeed run through the breaker. And I think the reason for that is because there is a BPR right here, also known as a balanced price range. And it literally respected it, I think, to the tick. Yeah, literally to the tick, it respected it, which is kind of insane that it respected it to the tick. That's wild. So balanced price range right there. And you got that fair value gap, but you would not pay attention to it, or whatever the word is. I can't believe I gotta like go and open. I wish I had a dictionary, just open it up and look for the word and find a definition, but I can't do that because I'm recording and teaching you right now. Like the recording is active. But disregard. That's the word I was looking for. You would disregard this fair value gap here, this bigger one, because it overlaps the smaller one, and you would use a smaller one because it's basically just been superpowered. It's been charged up. It's been supercharged basically. So this would be the stronger fair value gap. And as you can tell, just by in hindsight right now, you can see that price came down and immediately shot higher. Now, where is the liquidity engineering? What is it? Where is it? Okay. The liquidity engineering was price continuously seeking a temporary discount, and it did that by filling fair value gaps and seeking sell-side liquidity continuously without showing any bullish momentum. Okay, that entire thing right there, of it just not showing any bullish momentum and seeking sell-side liquidity, that's your manipulation. Okay, because mind you, this is another thing to tell if it's liquidity engineering, if it's engineering liquidity, is whenever it is seeking, for example, that's a huge stutter. We're not even going to pay attention to that. I might edit that out. But if your bias is bullish, okay, if you have a bullish bias and you expect price to go higher, and price is heading lower and seeking sell-side liquidity, and you can see it clear as day, pay attention to price. I'm going to say this again, pay attention to it. If we look here, is it really going lower? And what I mean by really, is it showing a willingness to go lower? Is it respecting bearish PD arrays? Is it showing bearish displacement? Is it really displacing away? Is it having bearish market structure and respecting it? It is. I really can't explain it. It is, but it's not going anywhere. Okay, that's really the main thing. You can have all the PD arrays in the world and it's respecting it, but if you don't have that displacement, if you don't have that willingness to go in that direction, price isn't going to do it, because price has to move in order to go somewhere. It's just common sense. If price wants to go somewhere, it's gonna do it. You know it is. If price wants to go somewhere, it's gonna do it. So we can clearly see that this is all manipulation, because whenever it goes lower, it just doesn't go lower. You get what I'm saying? It doesn't displace lower. It displaces lower, but very in a very short fashion. Okay, it displaces lower in a very short fashion, which would be considered manipulation, because our bias is bullish. And then we got accumulated liquidity up here for when the bullishness kicks in, and you get the whole thing. This whole thing right here is just manipulation. Okay, and then we can even see when the institutional order flow shifts, because we disrespect and overlap this bearish value gap, showing bullishness, creating a balanced price range. Price comes back down, seeks the balanced price range, respects it to the tick. It only goes one tick into it, which is absolutely amazing. If you want to see that for yourself, it literally respected it to the tick. Like if I get the measuring tool and go from like right here to right here, that is literally one tick. Literally one tick, and I was not kidding. That is literally one tick, as you can clearly see. One tick. And the 4 ticks make a whole point, so that's not even a whole point. Price goes into the balanced price range and sends higher into the accumulated liquidity right there. See how algorithmic and institutional this is? See how rigged these markets are? It's absolutely amazing, isn't it? But guess what? You're learning how to counter that. You're learning how to counter the riggedness or these manipulative markets. You're learning how to counter it, okay? So we're going to go over this again. We're going to review this once again. We're just going to turn it on. We'll turn it off and then turn it on. Boom, there's our lipstick. We've added lipstick to the charts. 9:30 opens up, okay? Once 9:30 opens up, we seek buy-side liquidity to begin our manipulation. Okay, what is the manipulation? Lower. So once 9:30 opens, we're like, okay, let's seek buy-side liquidity to grab some money so we can begin our manipulation. It does that. It has a little pre-manipulation, a mini manipulation before it manipulates. I can't really explain that, but it has a mini manipulation before manipulating, and then later in the day it distributes. But it comes up, takes out that high, and clearly it's a liquidity purge because it does not have the willingness to push through it. It displaces lower, manipulating into what? Sell-side liquidity and this fair value gap. Why did I highlight this fair value gap? Because it's right below sell-side liquidity, and if you haven't heard ICT say that, that is a very very high point of interest, okay, for you. It should be a very high point of interest for you. If it isn't, then that's probably a problem. Probably a problem. That was kind of a tongue twister. But as you can see, price came into the sell-side liquidity and into the fair value gap. After that, we come back up again into this rejection block I highlighted earlier. After that, we come to another rejection block right here, and then we finally send, and then price finally goes lower, okay, seeking sell-side liquidity again. But let's look at one thing. It's not running through these sell-side liquidity points. It's simply purging them. Okay, get that. Remember, whenever there's a purge, that means prices want to go there. It's going there temporarily. The real move hasn't unfolded yet. Okay, that's why we call it a purge, because it's temporarily going there and just purging or raiding or seeking or whatever you want to call it. It's raiding that side of the market before displacing higher, and that's exactly what's going on. As you see here, we come down into this low here. Let me drag this out just a little bit more. Comes down into this low here, immediately comes back up. We come down into this low here, immediately head back up. So we're showing weakness towards the downside. We don't want to go lower. But when we go up, oh, we show strength. We show strength. So this entire thing was liquidity engineering. Well, two points of liquidity engineering. Right here, okay. Well, no, 3 actually. Right here, and all this right here. All this, if I can like highlight it or draw it, but all of this, well, the drawing just came right back. But all that right there is liquidity engineering, okay? You got 1 right here. This is 1 point of liquidity engineering, because it, like I said, liquidity engineering is it's doing one thing to do another, okay? And what did it do? It went into this high, purged it in order to do what? Go lower and manipulate. So this is one form of liquidity engineering, or one case of liquidity engineering right along here. Our second is prices accumulating liquidity. That's the thing it's doing. And then the second thing that it wants to do is go higher. So it's accumulating liquidity while manipulating to go back higher. That's the second thing. The third thing is it's simply manipulating lower, continuously purging liquidity before heading higher. That's another form of liquidity engineering. Okay. So we got one purge, one accumulation, and two purge, which is basically this here. These two down moves, I would consider one whole purge because it's one whole case or one whole scenario of liquidity engineering. And then after that, we go right here. Price shows strength to the upside, creating a bullish breakup structure, come back down to that balanced price range, and I think respecting the equilibrium of this order block. I think, yes, it respects it to the tick. Wow, to the tick. And pay attention to how the equilibrium lines up with the, wow, this is crazy. What in the world am I teaching you, bro? This is crazy. The equilibrium is right on the balanced price range, and then it respects both of them to the tick. Man, okay, this is insane. I can't believe I'm teaching you this right now. But as you can see, this is clearly powerful. After that, it respects the equilibrium, and then it has an institutional order flow entry drill of the balanced price range, and then price finally shows that strength and displaces into that accumulated liquidity, which was the main objective for this. Okay, the sub objective for the accumulating liquidity engineering was to accumulate liquidity. That was a sub objective. Then the main objective was to run through it. And did price do that? Yes, it did. Okay. So as you see here, there's going to be multiple cases of liquidity engineering working together to send price in the expected direction. In this case, the expected direction or bias was bullish. Was it bullish? Let's see. Let's just, yep, it was bullish. We can confidently say it was bullish. And we can confidently say it was bullish from that point on. So let's go ahead and add an entry right here, because this is basically a trade that we can take since we've already analyzed and expected the manipulation. Then we set our stop down here at the bottom of the balanced price range. Then we can either set our target at the accumulated liquidity, well, that's one, or we can set it at this high here. Confirm that through standard deviation. No other than the standard deviation. And yeah, standard deviation says you can go right there, which gives you about a 2.5 risk to reward. But obviously, on the 1 minute, you can drop lower to like the 15-second and get that entry. You probably don't use 15-second, but in the future, I will be teaching you how to scalp, do stuff like that. Not necessarily scalp, but it's called micro market structure. That's what it's called, micro market structure. And I'll be teaching you how to drop all the way down to those lower time frames and basically teaching how to use them. Because what I do is just a 1 minute yap session real quick before I end this recording. But what I do is I trade on the 1 minute, 30-second, and 15-second. And what I'll do is I'll just wait. This is one of my forms of waiting. Okay, I'll look for this and I'll be like, okay, this is what price wants to do. And I'll wait for that perfect low risk entry, maybe just a little drawdown, but I'll wait for that perfect low risk entry, something like this. And once I get that entry, I'll hold the move for the rest of the day. Once it hits my conceptual target, which will be some point of liquidity, a fair value gap, maybe an intermediate term high, a short term high, something like that on a higher time frame though, since I'm catching the whole day's move. But just a little sample of what I do personally and how I'm gonna teach you that in the future with the 15-second and stuff like that through the exemplarity beacon of JJ, which is a series that goes through everything that I do personally. But anyways, we reached the end of this recording. Okay, this is approximately a 24 minute and 10-second recording. Okay, going on 24:15 now. But anyways, enough of me talking. Taught you enough in this. Hopefully I taught you well to where you can absorb the information and use it to your advantage when it comes to these rigged markets. As we can clearly see, they're rigged. And yeah, this is the end of liquidity engineering, and I'll see you on the next one. Peace.